Saudi IFRS 15, Revenue, the complete SOCPA interview masterclass. Hello and welcome to CandiMentor. Today we decode Saudi IFRS 15, Revenue, as applied under Saudi Arabia's SOCPA and Zakat Gazd regulatory environment. Saudi entities apply IFRS as endorsed by SOCPA, so the standard is technically identical to global IFRS 15, but the Saudi business ecosystem adds its own texture. Oil and gas service contracts, megaproject construction, long-term government contracts, Sharia-compliant structures, telecom bundles, and retail loyalty programs. Before we dive in, hit subscribe to CandiMentor. Saudi IFRS 15, what it is and why it matters. Saudi-listed entities and major groups apply full IFRS 15. The core idea is global, but practice reflects Saudi contractual patterns, payment cycles, and regulatory oversight. A useful opener, Saudi IFRS 15 is the global revenue standard applied within the Saudi regulatory, contractual, and industry environment. Common Saudi layers, government megaprojects, NEOM, Roshan, multi-year oilfield services, telecom bundles, STC, Zain, Mobily, construction claims, and loyalty programs. Then, within seconds, adding extra details and special departments, common Saudi layers and aspects of the environment. 22,000 APM freelance, first half second half 4. Mindec Global. Take these to the next level. High priority, high point, medical background, naming conventions, government, regulatory. All these, you remember to apply IFRS 15 to fitting, end with thinking critically, into differences and impact on project deadlines or projects related to confidential permit systems. These bring the concept into a higher level of confidence. Common IFRS 15, government, megaprojects, and loyalty programs. This is the global revenue standard applied within the Saudi regulatory, contractual, and industry environment. Permits, government megaprojects, and loyalty programs best be applied within the Saudi regulatory. Anchor yourself in the 5-step model. Always anchor answers on the 5-step model. 1. Identify the contract. 2. Identify the performance obligations. 3. Determine the transaction price. 4. Allocate the transaction price. 5. Recognize revenue when or as performance obligations are satisfied. Speak this sequence clearly. It structures every subsequent judgment. Step 1. Identify the contract. Saudi contracting reality. A contract must give enforceable rights and obligations, have commercial substance, and probable collectability. Saudi specifics to watch. Government contracts with complex payment schedules, advance payments and guarantees, formal tender instruments, and master service agreements with multiple purchase orders that may form one contract. Example, an EPC letter of award plus annexures often represents a single contract. Collectability is usually high for government counterparties, but payment timing can create a significant financing component. Step 2. Identify performance obligations. Saudi PO traps. A performance obligation is a distinct promise to transfer a good or service. Saudi complexities include EPC bundles, which may be one integrated obligation, handset plus plan plus content bundles in telecom, oilfield service packages combining chemicals and manpower, and hospitality event bundles. Ask, is the good or service separately identifiable in context? Handset and plan are often separate. Highly interdependent EPC elements often form one obligation. So on. Step 3. Determine the transaction price. Saudi pricing features. Transaction price includes fixed and variable amounts. Saudi contracts commonly include milestone payments, retention amounts, liquidated damages, performance bonuses, and escalation clauses. Estimate variable consideration using expected value or most likely amount. Then apply the constraint to avoid recognitions likely to reverse. Retentions and mobilization advances affect timing and possible financing components. Step 4. Allocation using standalone selling prices. Allocate the transaction price using standalone selling prices, SSP. If SSPs aren't observable, estimate via market assessment, expected cost plus margin, or residual approach. Saudi bundles are often customized, so prior bids, quoted price lists, and historical contracts provide SSP evidence. If chemicals have market prices but manpower does not, allocate observable SSPs first. Step 5. Recognizing revenue over time versus point in time. Revenue is recognized over time or at a point in time. Over time recognition applies when the customer receives benefits as work progresses. The customer controls the asset being created, or the asset has no alternative use, and the seller has a right to payment. Saudi over time examples: infrastructure construction, customized software, oil field maintenance, and long-term operational support. Point in time applies to simple equipment sales and retail transactions. Use output, milestones, or input cost-to-cost methods as appropriate. 1. Significant financing component, very common in Saudi Arabia. Large advances, long payment tails, and long retention release periods make financing components frequent in Saudi contracts. Compare payment timing to transfer of control. If differences are significant, separate interest income/expense from revenue. Mobilization advances and long-term milestone schedules commonly create significant financing components. Variable consideration. Saudi examples. Common Saudi forms of variable consideration: liquidated damages, negative variable consideration, performance bonuses, usage-based fees in telecom and data services, and penalties for delayed materials or logistics. Apply conservative estimation and the constraint principle. Saudi auditors challenge aggressive forecasts. Contract assets and contract liabilities. Saudi cash cycle reality. A contract asset arises when performance exceeds billings. A contract liability arises when payments precede performance. Mobilization advances and retention amounts in Saudi megaprojects produce large opening contract liabilities and ongoing contract asset balances. Ensure tight roll forwards and disclosure of timing. Contract costs. Capitalization in Saudi projects. Capitalize incremental costs to obtain a contract, commissions, and fulfillment costs that create future benefits, engineering design, mobilization. Amortize over the benefit period, typically aligned with project duration. Saudi contractors often capitalize mobilization and bid costs. Document recoverability. Contract modifications. Frequent in megaprojects. Variation orders, scope changes, inflation-driven renegotiations, and new work are common. Determine whether a modification is a separate contract, distinct and priced at SSP, or an adjustment to the existing contract, cumulative catch-up, or prospective accounting. Many Saudi projects require careful change order analysis. Principal versus agent. Control tests still key. Apply control-based indicators. Who controls goods/services? Pre-transfer. Who bears inventory risk? Who sets price? And who has primary fulfillment responsibility? Marketplaces and subcontracting arrangements in EPC projects need close assessment. Agents report net revenue. Principals report gross. Licenses, IP, and SaaS in Saudi tech sector. Distinguish right to use, point in time, versus right to access, over time. Saudi digital transformation drives many SaaS, hosting, and platform contracts. These typically recognize revenue over time due to ongoing access, updates, and hosting. Warranties. Assurance versus service. Assurance warranties, product meets spec, are expensed. Service warranties, extended support, are separate performance obligations and recognized over the warranty period. Extended warranties sold separately are typically separate obligations. End. Loyalty programs, material rights and breakage. Loyalty points are treated as material rights. Allocate consideration to points and goods and services, estimate breakage using historical patterns, and recognize breakage as performance obligations are satisfied. Saudi airlines, retailers, and e-commerce platforms use these models widely. Upfront fees, telecom, gyms, schools, activation, registration, or enrollment fees usually do not represent separate performance obligations. Recognize them over the service period unless they clearly purchase a distinct good or service. Bill and hold, controlled, rare cases. Revenue before delivery is allowed only when item is identified and ready. Customer requests bill and hold and controls the item, and seller cannot redirect it. This occasionally appears in industrial or government procurement. Auditors scrutinize these scenarios. Returns, refund liabilities, and right of return assets. When returns are possible, set up a refund liability and a right of return asset where required. Retail and electronics returns are common in Saudi markets. Model conservatively and disclose assumptions. Disclosures, what Saudi regulators expect. Saudi reporting often emphasizes disaggregation of revenue, government versus commercial, contract asset liability roll forwards, significant judgment on variable consideration, progress measurement methods for overtime revenue, and contract cost amortization. TADAWO-listed groups must disclose clear contract-level information for EPC and service revenues. Saudi industry scenarios. Use these in interviews. Oil field services, multi-year bundled services, performance-based consideration, overtime recognition. Construction and megaprojects, mobilization advances, variation orders, cost-to-cost input methods. Telecom, handset plan plus content bundles, activation fees, loyalty points. Retail, returns, promotions, breakage. Airlines and travel, mileage programs, ancillary revenue. Using a concrete Saudi example in each industry shows local awareness. Numerical example, clean walkthrough. Contract price, SAR 1 million. Expected cost, SAR 800,000. Costs incurred to date, SAR 200,000. Progress equals 25%. Revenue recognized equals 250,000. Journal. Full debit. Contract asset. SAR 250,000. Credit. Revenue. SAR 250,000. When invoiced. Full debit. Accounts receivable. Credit. Contract asset. Keep numbers simple and assumptions explicit. Journal entries. Full debit. Credit narration. Initial mobilization advance. Full debit. Cash. Credit contract liability. Recognizing revenue over time. Full debit, contract asset, credit, revenue. Billing, full debit, accounts receivable, credit, contract asset. Contract cost capitalization, full debit, contract cost asset, credit, cash. Amortization of capitalized cost, full debit, amortization expense, credit, contract cost asset. End. Practical interview tips, Saudi edition. Always start with the 5-step model. Mention mobilization advances, retention amounts, variation orders, and financing components. Use short numerical examples. Demonstrate conservative variable consideration logic. Be ready to discuss principal versus agent and SSP allocation. Refer to industry specifics, oil field services, NEOM, Telecom, to show regional fluency. Final wrap, Saudi IFRS 15 is global IFRS 15, applied within a Saudi ecosystem of long-term contracts, government counterparties, variable pricing, and bundled digital services. Anchor answers around the 5 steps. Identify the contract. Identify performance obligations. Determine and allocate price. And recognize revenue when control transfers. Document assumptions. Run small numerical tests. And show governance of estimates. This is what wins interviews in Saudi Arabia. If you learned something today, subscribe to CandiMentor. We're building the world's best learning hub for accounting, finance, and professional practice, and you should be part of it.